Good day, ladies and gentlemen. Welcome to Leago Rifumo Trading Podcast. This is episode 4. On today's episode, we are joined by Charles from CTA Research. Welcome, Charles. So let's get straight into it, Mr. Charles. Friday, it was a very important day in the market as we had non-farm payroll print, and it was a very, very important print according to me. It changed all the dynamics of the market on Friday, but let's discuss it. The markets were forecasting around 85,000 jobs to be added, and we actually got 172,000 and a revision from the previous month, which made this a very substantial beat by any measure. Charles, if we look back into Q1 or into the first quarter, the labor market was under real pressure as it was the Fed's biggest concerns going into the year. At that point, we looked that the Fed was actually entertaining the idea of rate cuts, trying to relieve the softening labor market. But now, the narrative has completely shifted considering the fact that the labor market has returned and we see an outbound in the labor market. We see the resilience in the labor market. At the same time, inflation continued to be stubborn given the war, the oil prices. But looking at these numbers, Charles, it was a very strong NFP beat on one side and persistent inflation on the other side. Looking into the scenario that I've just given to you, we look at the NFP data and we look at the inflation problem that we are currently facing. What is the broader market thinking going forward? And what's your take on it, looking into what CTA Research thinks and the broader market reaction with these labor market numbers?
Yes, from an operational standpoint, the Fed is essentially running a business with two primary KPIs, which is the employment stability and the price stability. When NFP members beat expectations significantly, the 182,000 versus 85,000, it signals that the macro machinery is running hot. So for the Fed, this is just a double-edged sword. While growth is positive for revenue, the GDP, it makes the cost of capital, which is the interest rates, harder to lower. So now if the economy is thriving, the Fed doesn't need to stimulate it. In fact, they may need to keep brakes on to avoid overheating, which is the inflation. The shift from rate cuts to persistent high rates creates a valuation headwind for every asset class that relies on cheap debt to fuel expansion.
Building on your answer, Charles, look, under normal market conditions, the equity market celebrates a strong labor market as a sign of economic growth and economic health. However, on Friday, we witnessed a complete opposite scenario where despite the very strong NFP print, we saw equity sell off sharply. I'm going to use Microsoft as an example. It was down approximately 2%. Indices was also down, but I'm going to look at Nasdaq particularly, which by New York close, it was down for about 5%. So the question to you is, what caused the narrative reaction in the equity despite the very strong NFP data, very positive economic data in terms of we look at NFP, we should be interpreting that as an economic good health. However, we have seen the market sell off. Why did the market interpret good news as bad news in this case specifically?
In business, we often say good news for the economy is bad news for the balance sheets in a high rate environment. The market sold off because it is repricing risk. If the economy is too strong, the Fed's higher to longer stance is solidified. For high growth sectors like Nasdaq, the math is simple. Their valuations are based on future cash flows discounted back to today. When that discount rate, the interest rate stays high, the present value of those future earnings shrinks. When you look at it, the market didn't interpret the jobs data as bad news. It interpreted it as a sign that the liquidity environment, the fuel for the equity rally, would remain expensive.
I do agree, Charles. Strong labor market, high CPI, Feds have to keep interest rate high or or hike interest rates. But looking at Broadcom earnings or equities, Broadcom earnings reported its recent earnings report. Revenue came in at approximately $22.19 billion against a forecast of $22.13 billion. Earnings per share was reported at $2.44, and the forecast was $2.396, which is a very strong earning report. But beside the report beating both top line and bottom line, Broadcom sold off immediately afterwards, and we saw semiconductor ETF on Friday closing at minus 3.5%, and Micron also started trading lower. Following the release of Broadcom earnings, we saw analysts started to speak about AI bubble narrative, to ask questions whether evaluations in the AI sector are far ahead of its fundamentals. So without dwelling so much into Broadcom specifically, and the reason being, Charles, you know that CTA Research is running a competition with its members doing mentorship and training with CTA Research. So to our listeners, please do check out CTA Research and join them, because they're doing this training, and in this case, companies that they're looking at is Broadcom, and they're running a competition with their members on Broadcom. Please check out ctaresearch.africa so that maybe you can be part of them, and they'll train you how to do equity research. But Charles, broadly speaking, give us your take as to why strong earnings result in the entire semiconductor ETF declining sharply, with Micron and its peers also selling off. What is the market telling us in this case, where we have strong earnings, but we see the semiconductors ETF and counterparts also selling off? Please tell us, what do you think about it?
As a COO, I look at expectations versus execution. Even when you execute well, if the market has priced in extraordinary growth, a good report isn't enough. You need a spectacular one. When a sector like Broadcom misses on forward guidance, even by a slim margin, it triggers an immediate reassessment of the entire supply chain. So now this sell-off wasn't about Broadcom's historical performance. It was about a market-wide de-risking event. Investors saw high valuations in AI, saw a potential softening in demand, and decided to lock in profits. It is a rotation from speculative AI hope to a more disciplined focus on sustainable cash flow.
Charles, I'm not going to dwell much on Broadcom fundamentals. I do wish to speak more about the fundamentals of Broadcom. However, I'm not going to do that because CTA Research is a competition with its members. To our listeners, if you want to learn more about equity analysis, please check out ctaresearch.africa. Just let's pivot back into the market, and this time around we're going to speak about the bond market, because a very important story is developing. Following a very strong labor data, the dollar closing firm on Friday, we also saw 10-year Treasury yield pushing higher. So Charles, with this resilient labor market now confirmed and inflation still elevated, does this scenario start to shift the possibility of rate cuts for the year, and we might have possible rate hikes? And do you think we are at the beginning of a genuine rotation in the market, away from rate sensitive assets into sectors that can produce better yield, like the bond market in this case? Please walk our listeners through what's happening in the bond market, and what could this mean for a portfolio position going forward?
We are seeing a transition from a growth at any cost era to an efficiency at all cost era. Now, when we look at the 10-year Treasury yield pushes higher, it forces every other asset to compete with the risk-free rate. So we are definitely in a rotation. Capital is flowing away from high beta, rate-sensitive growth stocks, and moving toward defensive sectors, and companies with robust balance sheets. those that can service their debt without needing constant refinancing. So as a COO, this is the time to optimize your cost structure because the easy money period is clearly over.
Now let's bring it home to the JSE, specifically Sibanye Stillwater, a name I've had my eye on for a while now. Following the release on Friday, we saw gold prices come under pressure, and Sibanye Stillwater followed that move lower. It's clear that the stock did not like the labor data on Friday. Now, as many of our listeners will recall on episode 2, if I'm not mistaken, I had flagged that I was expecting a lower move on Sibanye Stillwaters precisely because of its relationship with its relationship between Sibanye Stillwater and gold prices, and that this appears to be playing out. Charles, can you please explain the mechanics behind this move and why a strong US labor report translates into a down pressure on gold and in turn on a stock like Sibanye Stillwater, which is listed in the JSE? Help our listeners understand the connection between the two.
The mechanic here is the inverse correlation, between the US dollar and the commodities. When US jobs data is strong, the market expects higher interest rates. So now high interest rates makes the US more attractive to global investors, which drives the dollar higher. Since gold is denominated in USD, it becomes more expensive for foreign buyers, when the dollar strengthens, which typically drives the price of gold down. Sibanye Stillwater as a miner is a price taker. Their operational margins are directly tied to the spot price of the metals, they pull from the ground. If the commodity price drops, their projected cash flows drops as well. And the stock price, the market's best guess of their future value, follows suit.
And finally, let's zoom out and look at the broader South African market. The South African top 40 index closed down 1.15% on Friday. When we look at the year-to-date picture, the index is sitting at a decline of approximately 15%, which is quite sobering. My question is that the decline is being driven primarily by the weakness we see in commodities and mining counters, which carry significant weight on our exchange. Or the message you are getting is broader than that? Are we seeing a reflection of South African economy that is fundamentally and structurally linked to commodity cycle, meaning when global commodity demand softens or prices fall, our entire market feels it as well? And the reason for my question is we have seen the S&P 500 and Nasdaq making all-time highs in the New York Stock Exchange, while SA Top 40 Index is down approximately 15%. Where do you think the SA Top 40 Index goes to from here?
The JSE is heavily skewed toward resource counters, which acts as a proxy for global growth. When the world factory global demand slows down, the JSE feels it immediately. However, from an operational view, this is more than just commodities. It is a structural tax. If the cost of doing business in South Africa, electricity, logistics, and regulatory overhead remains high while commodity prices soften, domestic companies face a margin squeeze. So now, until we see a shift towards improved operational efficiencies and domestic reform, the SA40 will likely remain highly volatile, tied to whims of global commodity cycles rather than purely domestic growth.
Mr. Charles, this has been incredibly insightful conversation, exactly the kind of deep, honest market analysis our listeners tune in for. I really appreciate your time on episode 4. To our listeners, thank you for being part of the Rifumo Trading Podcast family. And also, if you want to take your trading and market knowledge to the next level, please look into CTA Research and the mentorship programs they offer. And again, please do not forget to like, subscribe, and share this podcast to all our retail traders and investors across the world. Thank you so much for joining me. Ndakens.